Welcome to The Explainer. There's a lot of anxiety shaking up the global bond market right now. And today we're going to make sense of it by unpacking two totally different realities. On one hand, we have a super calm, data-driven look at Japan from Anima Scraw, and on the other, a massive, urgent macro alarm bell about the U.S. from analyst Luke Gromen.
Okay, let's dive into this. Here is our roadmap for today. First up, the global bond jitters. Number 2, Japan's debt. 3, the mother of all crises. And finally, number 4, gold as the release valve.
Starting with Section 1, the global bond jitters. Are markets actually starting to crack?
I want you to think about this core question for a second. Is the foundation of global finance fracturing under record debt? It's a heavy thought, right? But it perfectly captures the psychology of global investors right now. Everyone is on edge, watching rising interest rates completely clash with historic, unprecedented debt burdens all over the world. People are essentially looking for that first domino to fall.
So what's driving all this bond anxiety? Well, the macro fears really boil down to this. Debt is just getting way more expensive. Financial systems are looking a bit wobbly, and there's growing speculation that capital might be forced back home. A prime example of this fear, the recent aggressive sell-off we saw in Japanese government bonds, or JGBs. A lot of folks viewed that as a potential trigger for a total global meltdown.
Which brings us to Section 2, Japan's debt. Don't panic. A local sell-off, not a global contagion.
To figure out if all this panic over Japan was actually justified, we turned to a research report from Anima Cigar. Their rates and FX strategy team took a really hard look at that broad sell-off in Japanese government bonds, and they concluded something pretty surprising. Basically, their analysts see absolutely no compelling case for Japanese yields just spiraling out of control.
And the data gives us a brilliant illustration of why. A staggering 90% of Japan's government debt is held domestically. That is a massive buffer. Because almost all the debt is held in-house, it inherently insulates their market from those sudden, volatile external shocks that usually trigger a full-blown sovereign debt crisis. On top of that, consider this number, 8.6 years. That is the average maturity of Japan's government debt. To put that into perspective, it's well above the G7 average of just 7 years. Because Japan has locked in this debt for such a long time, their financial system is basically a fortress against short-term interest rate spikes.
So, wrapping up Anima's 3 core reasons for calm. First, Japanese life insurers and pension funds hold their liabilities at book value, which completely shields them from immediate market panics. Second, you have that massive domestic ownership backing up debt sustainability. And third, the conditions for large-scale capital repatriation just aren't there right now. Essentially, the whole panic over Japan was a false alarm.
All right, let's pivot sharply into Section 3, the mother of all crises, the massive structural shift in the U.S.
So the crucial point here is that we're moving from the calm, measured data of Japan to what macro analyst Luke Gromen considers the real alarm. Gromen asks this one recurring, incredibly urgent question: what do you want? His thesis is that the U.S. is facing an impossible choice right now. Choice A, reshore the industrial base and win the AI race, or Choice B, protect the real value of the U.S. bond market. You literally cannot have both.
It really all comes down to a classic economic concept called the Triffin dilemma. In simple terms, as the holder of the global reserve currency, the U.S. is trapped. It cannot simultaneously suck capital back home to build massive physical factories and data centers, while at the exact same time expecting foreign capital to keep flowing outward into its treasury markets to fund its deficits. The math just doesn't work.
Gromen points out that winning the AI race isn't just some digital fantasy, it's a physical problem. He says, and I quote, "The constraint isn't chips. The constraint is grid. The constraint is rare earths." His entire argument is that winning this tech race requires massive tangible physical infrastructure. We're talking copper, energy, land. And the Federal Reserve? Well, they can't exactly print raw physical materials into existence, can they?
The infrastructure reality is incredibly stark. Look at the U.S. power grid. Capacity has essentially been stagnant for the last 20 years. Meanwhile, in just the last 10 years, China installed grid capacity equal to the entirety of the U.S. grid. Trying to rapidly build out AI data centers to catch up to this kind of structural deficit is going to put immense, unrelenting inflationary pressure on the American economy.
So how do you fund this massive reshoring effort without completely collapsing the economy? Well, Gromen expects the U.S. will eventually be forced into some form of yield curve control. If you're not familiar, that's a monetary policy where a central bank caps bond yields to artificially suppress borrowing costs. Effectively, the U.S. devalues the currency in order to fund that physical domestic growth.
Which leads us to the ultimate constraint, 120%. That is roughly where the U.S. debt-to-GDP ratio is sitting right now. Groman makes the point that at this extreme level of leverage, the U.S. economy simply cannot stomach a natural, high-interest rate cycle to fight inflation without experiencing severe dysfunction.
Let's move to our final section and see how this all builds together. Section 4. Gold as the release valve. Where does the capital actually go?
If the U.S. is caught in a macroeconomic trap where it basically has to devalue its currency, where on earth does the capital flow? Groman contrasts two assets often viewed as safe havens, gold and Bitcoin. He argues gold is uniquely positioned as a neutral asset that wins in both inflation and deflation. Bitcoin, on the other hand. Right now, he sees it trading way too much like a high-beta tech stock, tied directly to the very sector facing all those massive physical constraints we just talked about.
In fact, Groman views Bitcoin as, quote, the last functioning smoke alarm. It's a pretty fascinating analogy. In his bearish short-term view, the recent weakness in crypto isn't just market noise. He sees it as an early warning sign of rising real capital costs and potential near-term volatility across all risk assets.
Now, what's really interesting about this asset breakdown is the stark divergence between the two. Gold is completely insulated from AI capital constraints. It remains a true neutral asset, and it's experiencing massive, sustained buying from central banks. Bitcoin, however, is facing whale selling, deep tech correlations, and even lingering questions regarding future quantum computing vulnerabilities. And because U.S. official gold is at a historic low relative to foreign-held debt, Groman makes a pretty bold prediction. As capital seeks a neutral haven from this currency debasement, he calculates that gold could literally multiply 3 to 5 times in value as this new paradigm unfolds. That is a massive shift.
So today we looked at a really stark dichotomy: the stable, localized microdata of Japan versus an alarming, structural macro theory about the United States. And it leaves us with a vital question for you to ponder regarding your own financial positioning. As this macro paradigm shifts, are you positioned for the old bond market reality or the new physical constraints of the AI revolution? Thanks so much for joining me for this explainer, and I'll see you next time.